Hi, it's Larry Gaines from Options on the Open. We are the leaders in day trading and swing trading using options, and our goal is to help our members make consistent and impressive returns trading options every day. The old Wall Street adage, sell in May and go away, may become very appropriate this year for a number of reasons that could have a negative impact on the markets. Some of these reasons are: 1. A continuation of high oil prices hurting global demand, China and other countries raising interest rates to slow their economies and rein in inflation, thus decreasing their demand for a number of asset classes, an end to QE2 or quantitative easing 2 program set out by the Federal Reserve, which is to come to an end in mid-June. This ending of government stimulus will start to deflate asset prices and lead to the risk-off trades on a certain number of asset classes. Summer doldrums. Historically, the summertime is a weak period for markets. Markets can tend to correct down or even just go sideways. This is all bad news for a bull market, and this bad news can become really bad news if the buyers turn into sellers. Now, if we look back at last year for guidance, we remember that the Greek and European crisis was known for months, and the sell-off only occurred when the conditions really became front and center, as maybe the Federal Reserve ending QE2 and removing the stimulus from asset prices, which may lead to limited upside gains versus potential substantial downside correction or losses. Well, the markets are in an uptrend, that's for sure. But with these headwinds, one should be very, very careful and cautious, and look to trade more on a short-term basis, and also start looking for other strategies that are more neutral in nature. One such neutral strategy that we use at Options on the Open is the bull credit spread. In this strategy, you sell an out-of-the-money call and buy a further out-of-the-money call, the same number of contracts and the same expiration month, generally no more than 45 days out, in order to get the benefit of decay of time, or time decay of the option. The strategy works best in a sideways to down market, and I believe there's a good chance that this type of market may be just right around the corner based on the above reasons I gave you. This is a chart of the S&P 500, or the SPX, which is a CBOE index for the S&P 500. This is a monthly chart, and I wanted to lay out what I see on this chart. Right here, you can see this area here. This is from 2008. You can see when the market came up here, made new highs, you had a lot of length in the market, and then all of a sudden you had this major sell-off. Well, a lot of times you'll have this length trapped right here. A lot of these institutional investors or funds or ETFs or just individual investors will just hold. They won't sell. If they miss their sell point right here and this thing waterfall down, they're stuck here with supply. And they'll just wait it out. So here you go. We've had this great rally back up with really no headwinds. I mean, you can see no overhead supply back in this area. It only starts to accumulate right in here when you get up to this level right here where we currently are, like from the low, like 1360, 1350 in this area right here. So there's going to be a lot of people that did get trapped, or institutions. When you get up to this level in here, this 1360, 70 level, there's going to be some additional selling coming in just based on this trapped supply. So this supply has to get worked off before the markets can extend higher. And this is kind of what we're looking. It looks like this is what we're getting up against right now. So with this in mind, the markets could potentially, come up to this level, or they could just kind of go sideways and gradually move up to this level while this demand, or supply I should say, is absorbed and sold off. So with this in mind, what we did, we sold the 1375 calls here, this yellow line, and then above bought the 1395 to create this bull credit spread, the 1375 1395 spread. We collect premium, which goes straight to your bank account, and this particular spread will yield us a 5.75% return as long as the markets do not close above 1375 until the May expiration, which comes on May 20th. So this is the current spread that we have on. It's a neutral strategy. We want the market to either go down or sideways. I mean, it's fine if it just goes sideways. We'll make money because of the time decay. One thing I'd love to point out, and that is a really great advantage of a credit spread, is that you get the benefit of time decay of an option, even when the markets are closed. That's right. Every day the markets close on a weekend or a market holiday, time decay is still eating away at the option premium or the value of the option. So over the weekends, we get that added benefit. We're making money when the markets are closed, and I kind of like that. Well, this is just another bonus for members of Options on the Open. We not only day trade and swing trade using options, but we offer our members credit spreads and other option strategies based on market conditions. There are a number of option services that offer these types of income strategies for as much as $1,400 per month. But at Options on the Open, you get this as an additional bonus for your monthly membership fee of just $99 per month. So if you'd like to be involved with options and learn all these option strategies, please come join us at optionsontheopen.com. That's optionsontheopen.com, and thank you for your time.